Hello, all you lovely people out there. How are you all doing? I'm Kate Hill, and I am here to give you the best commentary about our property markets. Tina Howes is with me from SmartMove, one of Australia's leading and award-winning mortgage brokers. We are giving you a whole series explaining all things property finance, so stay tuned. Hello everyone, Tina and I are back to continue our series about all things property finance. It's a question that both of us actually get asked a lot. Do you fix or do you not fix your interest rate? We could talk about this all day, but we won't. There is a little boring disclaimer, I'm afraid, people, just before we get started. We have to remind everyone to remember that everyone is different. We are not giving personal financial advice here. Everyone has a different situation, different risk profile. It's not a one-size-fits-all approach. And we all need to consult with our mortgage and finance professionals before we make any of these decisions, right? This is a very general conversation that we are having here about Tina's and my own experiences. Okay, so the scene, we're setting the scene. Your loan has been pre-approved. You've gone and purchased the property, and there will come a time where you need to decide whether you're going to keep your loan as variable, whether you're going to fix it, are you going to split it, what are you going to do? And I think the key, I'm hoping that really the key takeaway point for everyone at the end of this one will be that if you think that by fixing your loan you will pay less money, you need to adjust your mindset, which is a fancy way of saying think again. And Tina and I both have little stories, quick stories about being burned fixing interest rates. You go first.
No, it was 2009.
Yeah.
I was working in corporate banking at the time, and interest rates were going up and up and up. And all of my treasury experts were saying, particularly to our, large corporate-based clients, now's the time to fix in. And I fixed in at 8%, I think it was. And then we had the GFC, and rates plummeted. That's not my only story.
No, I was going to say.
After vowing never ever to do it again, when rates went back down, there was a wonderful 5.69%. I still remember it, for 5-year rate. And I remember thinking, you know what, if I'm happy, if I can pay that for 5 years, having seen interest rates at that 8% level and, 6.5 to 7.5% average, I'll take that. And of course, rates went down to sort of 3%, and I was still fixed in. So, yeah. What's your story, Kate?
Well, picture the scene at the 2012 mark. So we're sort of GFCing-ish, but we have had that 8% business, and it's kind of come down to about 6.5. I've got, I think, 3 or 4 properties by then. I genuinely forget, sorry. And the broker at the time, we were discussing, because things were kind of coming down, but it had plateaued, I think, a little bit. And I fixed at something like 6.5 or 6.49, sort of is been burned on my memory.
Yeah.
And because things had been so high, again, the 6.5 seemed like a good idea. Thankfully, I did only fix for 3 years, because you could have set a timer. The moment I fixed interest, it could just kept going down and down and down and down. And it was also, unfortunately, at a time where a couple of the properties that I had were probably more regional, kind of Queensland, not exactly mining towns, but quite heavily mining affected, like your Gladstones, that sort of scenario, where then the rents also plummeted. So, I'm getting a lot less rent and I'm fixed at this interest rate. Can't do anything, and interest rates kept coming down and down and down. It would have made it a little bit more palatable to hold and to go through this whole thing, had I been able to do something about it. But fixing. I also swore never to do it again, and did not learn my lesson. Did it again once, in fairness only for 1 year, which I'm sure, as we'll find out, is totally pointless, really. But it was that other one that then took me, that's when I thought, yeah, I'm not going to fix again. I'm not going to do that again. Until just recently. So, explain to us, Tina, when it comes to, I guess there's certain situations here, right, that we need to talk through. But when it comes to fixing interest rates, we like to say, you know, when you're playing the cards, the house always wins. The banks never lose. Explain it to us.
Okay, all right. So I probably should start with the whole, I would have to say, aside from actually finding the property and getting your finance, deciding on whether to fix or stay variable is probably one of the toughest decisions. And it's been made more difficult given the cycle that we've just come out of.
Yes.
Whereby we've come out of a pandemic where the government introduced a lot of cheap funding to the banks, which was passed on at fixed rates. So if we put aside the pandemic for the moment, you'll basically be able to see that over time, fixed rates have been higher than variable rates. And there is usually a premium for entering into a fixed rate. And that is because the banks are generally factoring in an expected rate increase into that fixed rate before it's even happened.
Yeah.
Okay, so generally speaking, you're going to start paying a higher rate from day one, well ahead of the fixed rates actually going up. Now, behind the scenes, the banks are all about making profit. They've got really smart people in their treasury departments that, you know what's happening a lot more than you and I do, Kate, unfortunately.
Yeah.
And so if you look back, I would say over my, 17 years of being in finance, most clients, they've essentially ended up paying more overtime for fixing. Okay. So aside from the COVID really low rates where we had 1.79s, 1.89s, 1.99s for 4 years with major banks, if you put those to the side, the mindset that I like my clients to treat fixed rates is that you're essentially paying a premium for an insurance policy that protects you against any adverse situations that will result in rates going up sooner than expected or essentially protecting your cash flow. Now, like any insurance policy, whether it's car insurance, home contents, life insurance, you pay for that premium so that you can, have that comfort factor and sleep at night. But if you think you're doing it because you're going to beat the bank or you're going to do a cash flow and end up paying less, then I think you need to reframe that mindset. Okay. If you're comfortable with the amount of debt that you're getting into, you can sustain 1%, 2% increase in the interest rate, then I would be suggesting to think about whether you just stay on the floating rate. Another way of doing it is, let's say at the moment there's a 4-year rate that's at 2.99, where we've got a variable rate or a 1-year rate at 2.24%.
Yes, anyone watching the video, obviously we froze up a little bit there, guys. So we will pick it up mid-conversation from Tina, what you were saying about our 4 years at 2.8 something. Just
okay.
Go
so I'll give you an example. At the moment, we have a 2.89, 2.99 4-year fixed rates, but a variable rate on offer from the same lender at 2.24%.
Yes.
So if you locked in at the 4-year, you're going to start paying that premium straight away. Where the banks are essentially saying in the 4 years, we're not going to be seeing rates go up to that level until 3-4 years time. And that's what, depending on what you read in the papers, you will have one article saying rates going up tomorrow, another article saying it's 2022, 2023, 2024 before we start to see rates. So who do you believe? Quite frankly, no one really knows. So that's why I have that mindset that unless you're prepared to pay more from day one, then you can self-insure. So for example, if you were prepared to pay the 2.89% for 4 years, you could essentially start to make that repayment on the variable rate and put aside extra cash so that when rates do go up eventually, then you've already got the extra cash aside to be able to use to help you make that cash flow differential.
Yeah. Okay. I think that's really interesting. I mean, it's all really interesting, but it is when you think about like you said, the banks are smart. But at the end of the day, no one knows what's actually going to happen. Right?
No. And look, the banks are renowned to try and get you to fix in.
Why wouldn't
and
they?
look, some brokers as well, we encourage you to, because there's penalties to get out of fixed rate loans. So there's a real enticement to lock in. And I would like to say that I have had clients say, oh, we can't sell this property or we can't refinance because we're locked in. Let's take that up at that point in time. Now, if rates have gone up, then generally there is no break cost aside from a small exit fee of $300, for example. But those big penalties of break costs happen when the rates have gone down and you're locked in at 8% but want to get out at 5%, Kate. That's when you're going to have to pay the bank the differential of what they would have got for that period left to run.
Which, dare I say, it is kind of fair enough, right? Really?
Exactly. Whereas if you've locked in at the bottom of the market, say you've locked in last year at 1.99%, and then we've got rates going up, there's generally not going to be a break cost for you.
No.
So don't let that be prohibitive on you moving on with life.
That's right. Yeah. Okay. Talk to us a little bit about sort of this splitting. So perhaps split, keep some of it variable, leave your options open in terms of, I guess, those drawbacks that there are to fixing when they will stop you paying, or there's a, you can generally, I think it's only $10,000 that you can pay off, right? So leave yourself so pay some of it off.
So a few key points, generally speaking, there's always a couple of banks that, do let you have an offset account with a fix, but there's not many. And generally, because of that, and someone's got to pay for it, generally variable rate will be higher anyway to compensate for that. So do be wary of those. But generally speaking, you can't have an offset account against your fixed rate loan. You can't have redraw. So if you do make extra repayments, then you can't access that money until the end of the fixed rate period. Typically, you can make some extra repayments, but as you say, generally they're limited to around $10,000 per annum per year of the fixed rate period. So if you're locked in for 3 years, then perhaps you can put an extra 30 grand in, but you can't access that money until you get to the end of that period.
Which again, when you think about it from the bank's perspective, is fair enough. You can't have your cake and eat it, right?
Yes. So to compensate for all of that, if you are wanting that insurance policy, wanting to fix in so that you can, rest easy and sleep at night, not worry about interest rate rises, then I would strongly recommend that you work out how much cash you're going to have on day one, extra money from what you didn't use in terms of your purchase. So that's money that you want to leave either in your loan as redraw or in an offset account. So if you're looking at, say, locking in for 3 years, then you want to do a bit of a cash flow for yourself and say, okay, over 3 years, how much extra money are we likely to save? Are we getting any bonuses, any commissions, any windfalls of money, selling any assets? And whatever that figure is, then that's the amount that you really need to consider leaving in a variable rate loan so that you can have that offset or ability to make extra repayment feature.
Or if you've got multiple properties, don't fix the whole lot of them, leave yourselves, like you say, a couple of $100,000 or, the 1 or 2 that you can pay off. Which is my personal story, actually. I don't mind sharing that. There's some that I fixed, but there are 3 of those properties that I've left at variable. Because I'm hoping to, I am working very actively at debt reduction at my time of life. So I need to be able to pay them down,
Absolutely. So, and probably the other key point is when you do, say, buy that property, you've got your pre-approval and you're looking to convert it to formal approval. And your broker or your bank says, these are the rates.
So I'm going to ask you that. Okay. Then
but settlement's not for 4 weeks or 6 weeks or
6 weeks or 8 weeks, 2 months
3
now,
months time.
End of January, right?
Depending on the bank, but for most lenders, the rate that is advertised at the time that you put in your application for a formal approval compared to what it is, if it changes between then and settlement, then more than likely it's the rate that applies at settlement that you will have to have. And there is generally not enough time in that short period to say, oh, we don't want to fix anymore because we don't like where the rate went. We've changed our viewpoint, and then redocumenting or going back to a different bank. There generally isn't that time. So how do we protect against that? And it's a thing called rate lock, which is basically a premium that you pay to lock in that rate at the time of when you put in your application. Now, every bank has slightly different nuances. Some will be at the time they pick up your application. Others will be from the time that you've actually submitted it. Others are at formal approval. And then there are a handful of banks that have free rate lock, which basically means once you put your application in and then they approve it and document the application with that rate in the loan document, that's the rate that will apply. But those lenders are there are less of those lenders. Okay. So definitely discuss rate lock with your bank or broker as well.
Yes. So again, a lot to think about, to fix or not to fix. Have these conversations all the time. So think it through, discuss it with the broker. And I think it comes down to what I tell people a lot, and that is it's not just about now, it's mortgage planning to me is as important as anything else that you do, right? Think ahead, I mean, of course, life is always going to throw curveballs at us. We can't protect and forecast against everything, but do give the next few years a bit of a think through.
Absolutely.
What funds you're going to need access to, etc. Fabulous. Thank you, Tina, as always. Wonderful information for us all. And we will talk to you more about property finance very soon, everybody. See you soon.
Thanks,
Bye.
Bye.
I really hope that you found all of that useful. Tina is a mind of information. She and I will bring you lots more videos explaining all things property finance. Don't forget to leave us a comment and a question. And don't forget to hit the subscribe button, and also just give us a little like on the video if you are enjoying the free content. And we will see you really soon. Bye.